My name is C. Divas Gupta, and today we will be continuing our discussion on the live virtual revisionary classes. So the topics that we've covered in the previous session was around securitization and derivatives. Today, let's go through some of the questions on derivatives as well as within the topic of derivatives, one specific topic of real options. So let's start with question number 2, students. In our previous session, we have already covered question number 1. So these are some of the revisionary questions that we have put in. So question number 2, there is a spot of rupees 2000 and there is a 1 year futures which is being traded at 2250. The risk free rate is 10%. There is no dividend. It's given as a fact. And analyst identifies an arbitrage profit. The trader responds, it is impossible because our borrowing cost is 13% and not 10%. So in the previous part, they have given us what? Risk-free rate as 10%. But so analyst is of the view that there is an arbitrage that is possible. There is another person who is a trader and that person is saying it is impossible because our borrowing cost is 13%. You're required to comment on the above statement. So with this facts, we are supposed to comment whether the arbitrage is possible or not with a realistic rate of 13%. So let's first examine whether arbitrage is possible at 10% or not, and then maybe we will be able to conclude how that arbitrage possibility arrives when the borrowing cost is 13%, students. Okay, so let's start with the solution. Yeah. Okay, so I'm just writing what all things are given. So spot price was given as 2000. Futures price was given as 2250. Risk free rate is given as 10% and incremental, or it uses only the borrowing cost. Borrowing cost is 13%. Okay, so theoretical fair value is actually given as on 2000. If I take 10% compounding, right, basis the valuation principles of forwards and futures we have discussed, right, spot price multiplied by the interest rate, which actually gives us 2200 as the theoretical fair value. What is the rate at which market futures are being traded? These are being traded as 2250. So if in the market something is being traded at a higher price than its theoretical value, then what situation we call this as? This situation is called as overvalued, right? Futures are overvalued. That means futures are being traded at a higher value than it should be. So then we say that this looks overvalued, and hence the arbitrage profit can look like as 50 rupees, right? Because what I have to do in case something is overvalued, I will sell futures. Because I have sold the futures in the futures market, what I'm going to do? I'm going to buy in spot market. Correct? This is the strategy that we have discussed in our previous sessions. If I'm going to do selling in futures, I have to do a reverse action in the spot market, right? So I will buy in the spot market, buy a share in the spot market. Now, in this case, what will happen as a next step? If I have to buy in the spot market, I need funds. I would need funding, right? The moment I say I would need funding, I will have to borrow how much? 2000 rupees, because arbitrage is always assumed to have zero savings, zero investments on day one. Whatever you need, you can borrow, and then whatever is your proceeds on maturity, whatever is your profit that you can keep and balance, you have to pay it back, right? So, in such a case, I need a funding of 2000 rupees. The moment I need a funding of 2000 rupees, I will borrow the amount required to borrow for purchasing one share is rupees 2000. Now this borrowing will happen at what? This borrowing will happen at 13%. 13%. So effectively, my cost will be 2000 multiplied by 1.13, right? Which is 2260. So this is what? This is the maturity of borrowing. The moment it becomes 2260, now what will happen? My futures are logged at 2250. Cash outflow on maturity is 2260. Correct? So futures are at 2250. The cash outflow on maturity is 2260. So that means my realization is going to be maximum 2250, but I have to pay out 2260. So that means I will be at a loss of 10 rupees. Correct? So in our question, the trader's plea was correct, because the trader was saying that it is impossible because our borrowing cost is 13% and not 10%. So arbitrage is not possible. So with this calculation, students, with this calculation, we can very much confirm that if we do a hedging, or if we try to do arbitrage here, the possibility of getting the arbitrage profit is not there. Why? Because the actual borrowing cost is 13% and not 10%. Now the question comes that in which situation the arbitrage profit would have been possible, if not in this situation. So if the risk-free rate is 10% and actual borrowing cost would also have been 10%, then the arbitrage would have been possible, students. Clear? So I'm just writing it. Hence, the trader's statement is correct as there is a net loss of rupees 10. Clear? So this is the solution for the second question, students. So there was a very good catch wherein the risk-free rate and the actual borrowing rate is different, and hence the arbitrage is not possible. Okay. Then students, let's come to question number 3. A family office owns 50,000 shares of Omega Limited. A family office means basically there are promoters, and those promoters, whenever they have to, let's say, invest their own fundings or their own monies, that happens through a family office. Okay. So they own 50,000 shares of Omega Limited. Current market price is 850. The CIO, the Chief Investment Officer, means believes the stock will remain largely stable over the next 3 months. So they are saying it will remain stable over the next 3 months. There are these available options at a strike rate of 900 and with a premium of 35. The office is considering writing covered calls. Writing covered calls. Why do they need to write a call? Let's examine this situation first. Why do they need to write a call? It's simple, because in the spot market, they are holding long position in Omega shares, and in the options, if they write a call, that means they are selling the right to buy. If they're selling the right to buy and tomorrow the options get exercised, okay, they will have to sell the underlying, correct? So which will be a opposite position in options, which is what we need to secure a hedge, correct? So possible stock prices are what? 820 and 900. Calculate payoffs in each scenario. Now, students, this is a question from a writer perspective. So we will have to think through from a writer perspective, not from the holder perspective. Okay. Let's come to the solution of question number 3. Yeah. So first of all, since we have written the call option as a writer of call option, premium to be charged is how much? 35 was for one option, and they are holding 50,000 shares. So that means 50,000 options. So this is premium per option, and these are the number of options. Okay. So this is going to be 17 lakh 50,000. This is what they're receiving a premium of. Correct? That is their income. Now let's see the current market price is given as 850, right? That is what they are holding at. Now, the moment it reduces at 820, right? The moment it gets reduced at 820, there is a stock loss, right? That they have to incur, which is 850 minus 820. So 30 rupees per share, they have incurred a loss because they are currently holding the shares, right? And overall loss is computed as 30 into 50,000, right? Which is minus 15 lakhs, right? This is the loss that they have incurred. But there is a premium that you have received, right, by writing the call. So the premium offset loss, which will be 17 lakh 50,000 minus 15 lakh above, and hence 2 lakh 50,000 is going to be my net profit. And the last thing which is left to be included in this is there any payoffs of the call option written at 820? So students, what was the strike price? 900. So strike price is 900. Then spot price as per scenario 1 is 820. So it is out of the money, right? We have taken a call option. We have written a call option. The call option will become out of the money because the actual price is lower than the strike price. So there will be not any payout on account of this, students. Okay. Now let's move to the second scenario. The second scenario, it says that at rupees 900, right? That's the second scenario. Now, the moment it happens at 900, first of all, there is a gain that will come on account of the shares holding. So, gain will be coming to the extent of 900 minus 850 multiplied by 50,000. Correct? So, this becomes 50 into 50,000, which is actually 25 lakh rupees. Right? This is a pure gain on the holding of the shares. Then obviously there is a premium that is also charged and received earlier because of the writing of the call. So this is going to be 17 lakh 50,000. Clear? Now we have to also evaluate whether there is any payoff at the option level. Payoffs at option level will be what? Strike price 900, spot price is also 900. So it is at the money. Clear? So it's not leading to any cash outflows from the writer of the call. So hence, overall gain comes out to be 25 lakhs plus 17 lakh 50,000. This is actually 42 lakh 50,000. Clear? So this is an overall gain that is coming out to be this. Okay. Now, this is what the question had asked, right? But I would also like to introduce one more case here. The third case, which is, let's say, price is becoming 950. Now, this is a tricky one. If the price has become 950, so what all things will happen? First of all, we have to calculate gain, correct? So gain will be 950 minus 850 into 50,000. So this is 100 into 50,000, which means 50 lakh rupees is the gain on the holding of shares. That's the primary gain. Now, second is the premium that has been received on account of writing the call option. That premium was how much? 17 lakh 50,000. And lastly, we will also see call options payoffs. Now, in this case, the strike price is actually 900. The spot price has become 950. So it is in the money. Correct? Now, this option will become in the money. And hence, this 50 rupees, will it be a gain or will it be a loss? In case of a call option, if it is in the money to the option writer, it's a loss. Correct? So this 50 rupees on 50,000 options is going to be the loss. So which is 50 into 50,000, right? So this is going to be 25 lakhs. Okay. So this is a loss. So the overall position is a gain of 50 lakhs plus a gain of premium 17 lakh 50,000 minus 25 lakh of loss on the call option that the writer has to make good. Now this becomes how much? 67 lakh 50,000 minus 25 lakh. This becomes 42 lakh 50,000. Now this is something that I want to actually correlate to, that this 42 lakh 50,000 and this 42 lakh 50,000 is always going to be remaining same had this price even been 910 or 905 or 920 or even 1000 rupees. So whatever the price may be beyond 900, this 42 lakh 50,000 is the maximum earning potential for this family office. I hope this is clear. If the prices are lower, the earning potential will be lower, that we have seen here, right? Which is at 820, there is a net profit of only 2,50,000 because of the gain or the loss. But since we have a return a call option, whatever extra we are getting over and above 900, that we have to pay. And hence the maximum amount of profit that we can put is 42,50,000. Clear, students? So this was question number 3, students. Now let me quickly come to the some of the revisionary aspects of derivatives. Let's quickly spend some more time, which was there about the topics that we have not covered in the previous session. Then we will move to the real option questions. Okay. This all we have covered. Yes. So we have to cover quickly on the valuation techniques of the options, right? So students, there are different methods of valuing an option. So the first method is binomial method. Binomial methods, as the name suggests, is by. By means two. There are two options, whether upper or lower. So whether the prices can be higher or lower, depending on that, we calculate the value of the options. In this, we have to calculate a decision tree. We have to make a decision tree, and that decision tree will actually lead us that in which situations the options become exercisable, in which situation the options doesn't become exercisable. And for all the ups and downs, right? Probability of prices going up or the probability of prices going down, we have to calculate these probabilities, for which there are this formula that we have discussed in detail in the detailed sessions. Okay. So once it is there, then we can easily calculate that what is the best likely value, best estimated value as on the date on the future. And then we can take a present value of it to arrive at the current price of the options, right? Then risk neutral method is also a way to calculate a probability, and the formula here and the above formula, both of them are interrelated. So here we say that the current actual price is a present value of the best estimated expected price, right? Which is this, and hence using this we can calculate the probability. But students, please do remember, in this there is always an assumption that there are only two possibilities the prices can move, either up or down. Clear? So value of the option, students, ultimately becomes what? Present value of the probability adjusted payoffs. At each and every node, whatever is the probability adjusted payoffs, that we have to take a present value to arrive at the value of the options. Right? Then these are some of the questions. I'm just going to the concepts, then questions we will come to our. So this is how an example of a decision tree looks like, right? For example, A will have two possibilities, B or C. Similarly, B will also have two possibilities, D or E. And even C will also have two possibilities, E and F. Now, what prices it will move up or down, that will be given in the question, right? Or the way to calculate is all would also be given in the question. Yes. Then we discussed about these four different cases, students. So the case one, in case we are doing a long call option, that means we are purchasing a call option, that is a right to buy, correct? We are purchasing the right to buy. In case we are purchasing a right to buy, then in future we have to purchase the share, correct? And in future, in case we have to purchase the share, what we will do, we will invest the present value of the strike price today, so that on maturity we receive the amount and we pay the amount to purchase the share. The case number two was where we do the short of the call option. So just now the question that we have discussed, right? In case we are shorting a call option, that means we are selling a right to buy. We will have to purchase a share today, correct? That was there in the family office where the chief investment officer already had shares and they were trying to write a call. Then case number three, which is the long off put option. That means we are purchasing a put option, purchasing a right to sell. If you're purchasing a right to sell, that means I need to have the share today so that tomorrow, if I'm executing the option, I can sell the share. So I have to purchase a share today. Similarly, case number four, if I'm having a short of put option, that means I have sold a put option. That means I have sold a right to sell, correct? In that case, if tomorrow the option get exercised, I will have to purchase it, correct? Because the other person will be selling it. So I have to invest the present value of the strike price today so that tomorrow I can actually purchase it. Clear? Option premium is always reflective of the extent to which it is in the money adjusted for time value of money. Okay, so always remember the fact that option premium is always going in tandem with what is the extent to which the option is in the money, right? And it is always adjusted for the time value of the money. Okay, then let's move to using these four cases, we have actually arrived at how the Black-Scholes model formula works, right? And this is very, very important for us to understand. It's not only just we have to crunch the, or let's say we have to just remember the formula, we have to just also get behind the reasonings and the logics of this formula. Okay, because the way the questions are being asked in the examination, they are actually really testing the understanding of the formula, how far we understand the formula. So in this case, we said that using the same line that I said, that the option premium is always reflective of the extent to which option is in the money adjusted for the time value of money, right? Now, for this, let's take case number two. For proving the valuation of a call option, I am taking the case number two where I am selling a call option and I'm purchasing a share today. So I have purchased a share today. So that will be a cash outflow today, right? Which is equivalent to the spot price. Second, I'm selling the right to buy. That means I will write a call option. So the cash inflow will be strike price, correct? Because if I'm selling the right to buy and tomorrow I have to sell the actual share, I will get the strike price equivalent amount, correct? So 100 becomes the cash outflow today, which is the payment, minus 90 is what I will receive. I am receiving 10 rupees less. So if I am receiving 10 rupees less, ideally I should charge 10 rupees as premium, correct? That's the simple thought process. So A minus B, where A is shares purchased and B is the option being the present value of the, sorry, the strike price, that becomes my premium. But here is a catch now. A happens today and B will happen after 3 months. Now, if A is happening today and B will happen after 3 months, I cannot simply compare A and B. What I will have to do? I will have to actually replace B as present value of B. Okay. A will remain as is and B I have to replace as present value of B, which will be equal to the premium. Right? And premium is actually given by A minus present value of B. Clear? Now, premium also needs to take into account two more things. If I just say that spot price minus present value of strike price becomes my premium, then I am taking an inherent assumption that one share is equal to one option. But in reality, it is not. It is given by a hedge ratio, correct? And hedge ratio is very, very important when it comes to futures, forwards, and options all. So hedge ratio will give us how many shares to be purchased so as to write one call option, correct? And there is a way to calculate the hedge ratio. We will come to that. So what we are going to do is we are just multiplying the spot price with the hedge ratio, correct? Now, till here, we have also taken one wrong assumption. That assumption is that this option will get executed. Although in reality, this option might not get executed, but we are taking an assumption that this option will get executed. Now, that assumption, we have to actually replace it with the mathematical factor, which is that the assumption that the option is in the money, that also we have to take into account. So premium of the call option is given by spot price multiplied by hedge ratio minus present value of strike price. We were okay till here. Now what additional factor we are introducing is that what is the probability that the spot price on expiry is higher than the strike price? Because only in this situation the option becomes exercisable. only in this situation the option becomes exercisable. Clear? Here there is a spot price, there is a hedge ratio minus there is a present value of strike price. But we have to also be cognizant of the fact that what is the probability that the option becomes exercisable. So now if we convert this formula to mathematically derived equation, it becomes premium is equal to S into ND1 minus E into E minus RT multiplied by ND2. So this spot price is the spot price itself. The strike price is the present value of the strike price itself. ND1 becomes the hedge ratio and ND2 becomes the probability. Clear? And there is a way to calculate ND1 and ND2, which is D1 and D2, the natural distribution table of D1 and D2. And here it comes the mathematical detailed formula, right? That we have discussed in detail in the session. Okay. So sometimes the question will tell you instead of ND2, it will just replace this statement and it will tell you that the probability that spot price on expiry is higher than the strike price is this much. Similarly, it can tell you instead of giving the ND1 value, it can tell you the hedge ratio is this much. Yeah. So we have to be careful of what values has to be applied where. Clear? Then these are the normal distribution table values D1, D2, and this is all what we have discussed. This is a concept on the normal distribution table, which is actually the area under the curve represents the probability. And there are some characteristics of this that we have discussed in the sessions. There is a Z score that we calculate here, correct? And that Z score becomes the calculating factor for the area under the curve. And in this, we always assume the mean to be 0 and standard deviation to be 1. And hence we do what? We do reduce it from the mean and divided it by the standard deviation. To convert any table, any distribution into a standard normal distribution, we generally do this. Okay. Then this is all I think discussed in detail in the sessions. Yes. Now, similar way, the put options Black-Scholes model calculation is actually given through case number 4. Here we say that if we are going to sell a put option and then we are also going to sell the equity share, right? The case number 4 was about that. So selling the put option will be cash outflow to the extent of strike price, right? And selling the equity share will be cash inflow of the spot price. So what I'm going to do today, I'm first of all going to borrow an equity share. I'm going to short sell that equity share in the market, invest the present value of the strike price today, redeem the present value of the strike price on maturity, and then purchase one equity share back through the put option and give it back to the borrower. Simple. Now, in case we have to understand this equation, so here the ND1 and ND2 becomes N minus D1 and N minus D2. And the next part of the equation becomes the first part becomes the next part. How? Because this is the present value of the strike price. This is actually the probability that the price is lower than the strike price. So if ND2 represents that the price will be higher, N minus D2 will represent that the price will be lower than the strike price. Right? And N minus D1 is again the hedge ratio in case of a put option, and S becomes the spot price. Clear? Now this is just a summary that we have discussed about forward, futures and options, concepts, hedgings and valuations, right? Their uses and all those things. Now put call parity theory is another topic that we would want to discuss. I'm just leading to the conclusion in this because using these two case studies, we have actually arrived at the value will always going to be same. So put call parity theory says that whatever form you do, you will always hold this equation good. What is this equation? It says that the value of the put, the pricing of the premium of the put plus spot price is always going to be equal to the present value of strike price plus call option pricing. And the reason of this is already discussed in detail with three or four different scenarios. It is only based on a very simple premise that if today I am spending 15 rupees in this and 20 rupees into this, but after let's say 1 year, I'm getting 25 in both of them, right? So that means this 15 and 20 will also converge to a common number, which is 17, because the investor will be coming onto the common ground to invest, and then they are going to get the similar amount of money later on. Clear, students? So this is what the put call parity theory is. Okay. And one more thing, it is useful in the cases where we have one, let's say, value, and we have to come to the second value. Okay. Then this is all about the formulas and everything. Yeah, then there are these Greeks which I'm not discussing as of now because these are simpler. These are the factors affecting the premium of option. Whatever factors goes into the calculation of the premium of option, all of them become a Greek in some way or the other, right? And they all have different characteristics, different um, magnitude. Then there is a term called credit derivatives, wherein we have discussed about that. Till now we have discussed about the financial derivatives, right, which have an underlying as equity shares and other things, whether it is forwards, futures, and options. Credit derivatives is basically a derivative which covers the credit risk as an underlying. Okay, so it will actually be on account of the non-payment risk by the counterparty, non-fulfillment of the obligation by the counterparty. So there are different forms of credit derivatives. The first one is the collateralized debt obligations. In this case, we have already discussed in the securitization topic that there are two kinds of uh, you know things. One is the mortgage-backed security. Second one is the asset-backed securities, right? Now, within that, we have also discussed about the tranches, whether it is senior, mezzanine, or equity, right? So, so converting the illiquid asset into marketable securities of tranches is called as collateralized debt obligations, right? Then there are different types of CDOs. The second type of credit derivative is credit default swap. In this case, the swap is taken with a entity in which whether there is any credit default later on, it will be swapped against the payment of the full amount to the entity who has incurred that swap. And for this, there is a premium that is being charged on the overall loan amount. Okay, overall debt amount. So it is as good as tomorrow. It's like an insurance. So tomorrow, if let's say your one of the collection goes bad, then we will actually go and make you good. That's what the premium is paid for. Yeah. So I think, yeah, that's all from the revisionary aspects. Then there is another topic of um, real options. Yes, this one. Perfect. So let's students, 5 or 10 minutes, let's put on the real options and then we can go to the questions of real options. The revisionary questions on the real options. So, real options are the options where the underlying is a long term project, which is generally evaluated as capital budgeting decisions. Now, students, what happens in the previous, let's say, levels, you would have seen that what is the how the capital budgeting decisions are evaluated. But in practical reality, there is a lot of variability in the cash inflows, cash outflows, even the time period for computation of such amounts, right? So hence, these are these options actually cover up for the of the variability of the changes in these factors, right? Now, by the name or terminology, we know that call is the right to buy and put is the right to sell. From real options perspective, call becomes right to invest because I'm entering into that project, I'm investing, and put means right to disinvest so that I am exiting out of that investment. Now, capital budgeting is basically used around discounted cash flow method, right? And there are two things, right? One is the financial options, second one is the real options. So the financial options is the place where we have discussed about the underlying as share, stocks, bonds, commodity, which are traded in the market. Real options are the ones that are covering underlying as the projects, but these projects are not traded in the market, right? So here the payoffs are fixed. Here the payoffs becomes variable. The exercise period is up to 1 year, which is a shorter period. In this case, it becomes more, which is greater than even 1 year, right? Because the projects are long term in nature. The approach here is that we always say that the options are priced. The financial options are priced. In this case, we always say that these are valued because we talk about options. We talk about projects here, right? So yes, I think long call means that I am purchasing a right to invest at a future date, right? To enter into a business, to expand a business. This is where it is used. Longing a put means that I'm purchasing a right to disinvest, right? At a certain price at a future date, or I can say it is a right to abandon at some future date or at a certain price. Short call means a commitment to disinvest upon the action of counterparty to call option. And short put means a commitment to invest upon the action of counterparty to put an option. So it is a vice versa of long call and long put, right? In case the counterparty tells you to do so, you will be entering to doing such things, right? Then option holder has a right to invest, future date, and option writer has a commitment to disinvest in case the option holder says it so. Similarly, option holder has a right to disinvest. The option writer says that commitment to invest. Okay. Then about the valuation, students. We have discussed about the binomial model, risk neutral method, and Black-Scholes model, right? So these are the topics. These are the methods that are applicable here as well. Then let's come to some of the questions, students, of so we will cover the balance part of real options through these questions now. Okay. So let's come to question number 4 from our assignment. Till third we have covered. Let's come to question number 4, students. I'm just increasing the size so that it is properly visible. Yeah. Okay. So the question number 4 is, if ABC Limited is evaluating a project requiring an immediate investment of 100 crores. Okay. So what they are saying is that ABC Limited wants to invest 100 crores and they're evaluating a project for that. If undertaken today, the project has present value of cash inflows of 95 crores and the initial investment of 100 crores. So this is cash inflow, this is cash outflow, right? So cash outflow is higher and cash inflow is lower. Management may wait 1 year. So they are saying that they are okay to wait after 1 year, for 1 year. After 1 year, what will happen? Demand may be higher or demand may be low. In case demand is higher, it has a 60% of the probability. The demand being low has only a 40% probability. Project values after 1 year becomes how much? For high probability, it's 140 crores, and for low ones, it is 80 crores, right? We are talking about the present value of the inflows. The investment cost remains 100 crores, right? This is what it is. So the cash outflow remains 100 crores, but there is a change in the realization of the present value of the inflows. The risk free rate is 5% required. Evaluate whether the company should invest now or wait. So these are the typical questions that actually comes from a perspective of real options, right? So I think the question is fairly simple. It has given you a set of facts where there is an option to invest now, there is an option to invest after 1 year. In case we move to after 1 year, there are different issues, and how we are addressing those is something there we have to discuss. So let's start. So we are coming to solution number 4. Okay. So first of all, let's calculate step 1 as n net present value as on today. So which is NPV is given as cash inflows, present value of cash inflows minus present value of cash outflows, right? So this is actually 95 minus 100. So NPV becomes minus 5 crores, right? This is what the NPV becomes. So first of all, in case we are evaluating an option to invest today, the answer is no. So we have to actually reject under investing, reject investing today without any option to invest after 1 year. So that means on a standalone basis, I'm if I'm evaluating this, I'm going to reject this, right? This is what we are saying. Now, step 2. Let's introduce the concept of evaluation of investment after 1 year, right? If there is a high demand, what was the cash inflow? 140, right? Minus 100 crore remains the same. So rupees 40 crores in case of high demand. In case of low demand, we come to 80 minus 100, correct? Which is minus 20 crores, correct? So 80 was my cash inflow, 100 is the cash outflow. So minus 20 crores becomes my cash. So minus 20 crores becomes the negative NPV, right? Now, in case the probability or in case the situation of lower demand comes after 1 year, right? Now, I'm standing after 1 year, students, think it through. I'm standing after 1 year, and if I come to know that, okay, the lower demand situation has arisen, I will not undertake this project, right? Because the NPV is negative. So, what I will do in case of a low demand project will not be undertaken, the value will become zero. The value will become zero. Okay. Then step 3 is about the expected payoff. Now, expected payoff will happen only on this 40 crores, right? Only on this 40 crores. But this expected payoff of 40 crores will have an implication of what? It should be multiplied with the probability plus 0 into 0.40. Correct? Here I am taking 0, not as minus 20. Clear, students? Because in this case, the project will not be undertaken. So the expected payoff becomes 40 into zero point 0.6, 24 crores. The present value of expected payoff. Now think it through. This is actually step 4. This expected payoff is calculated after 1 year, right? This will come to us after 1 year. Now we are evaluating decision today. We have to bring this value to today. 24 divided by 1.05. This was the risk-free rate of return. Correct? 5%. So this becomes how much? 22.86. So technically 22.86 becomes the value of option in case the investment is done after 1 year, because till then you have better clarity, right? So our overall conclusion is what? Since option. So one thing is very clear. Investment should not happen today. Right? That's we discussed on a standalone basis. Investment should not happen today. But since option value is positive, the company should wait rather than invest today. Clear, students? So our final conclusion is that since the overall value of this option looks to be positive, the company should wait rather than investing today. Okay. Next question, students. Question number 5. Zenith Chemicals is setting up a small specialty chemical plant. Yeah, let's focus on question number 5. Zenith Chemicals is setting up a small specialty chemical plant. Initial investment is 150 crore. Base project NPV is 20 crore. So they are saying the NPV that they will be getting is 20 crores. After 2 years, if market demand is strong, the company can expand its operations. Expansion requires, after 2 years, how much it requires? 40 crores. Additional present value of cash inflows from expansion is 75 crores. Probability of strong demand is only 50% and discount rate is 10%. Calculate the value of expansion option. Now, this is a question on expansion option. Somewhat similar, but it has a probability element again, which is also similar. But here, the option is to expand on the existing project. So, students, what we have to do here, first of all, we have to calculate the expansion related NPVs, right? So, solution 5. Step 1 is calculating the additional NPV if expansion occurs. 75 minus 40 is equal to rupees 35 crores, right? So 75 was the cash inflow, 40 is the cash outflow, so 35 crore is the amount that we will get during the expansion option. But there is a probability attached to it, right? So step 2 will be to calculate the expected value of expansion. 35 crores multiplied by 0.50. So this is 17.5 crores, right? Then step 3 will be also the present value of expansion option. Right? This will be calculated how? 17.5 crores is the NPV. After 2 years, we have to calculate the present value of it. So this becomes 14.46. Okay. And lastly, what is the overall project value? So today it was positive, right? Today's NPV is 20 crore positive. So strategic project value is 20 plus 14.46, right? Which is actually 34.46. Okay. So the expansion option value is 14.46 crores. Expansion strategic NPV is 34.46 crores. Yeah, I hope this is clear. So if you see the questions on real options are around that, you know, whether to wait now or to invest now, or how the expansion will happen with some probabilities in place, right? So those are the overall concepts in the real options. Let's move to the next question, students, which is question number 6. I think the question number 6, I have to actually, yes, yes. So this is the question number 6, students. A mining company is evaluating a project. The initial investment of the project is 200 crore. Present value of expected inflows is 185 crores. So this is basically, we are talking that the inflows are lower but outflows are higher. At the end of year 2, if commodity price collapse, the project may be abandoned and equipment, sorry, and equipment may be sold for 60 crores. So they are saying that after year 2, if let's say the prices are very low, then we might have to abandon the project and it will be sold for 60 crores. The probability of collapse is 30%. The present value of continuing project in a bad state is only 20 rupees crore. Discount rate is 10%. What is required here? To calculate the abandonment option value. Okay. So let's put down with the facts. Now, students, if you see this, so there are two options available after year 2 for the company, right? One, either to abandon, second, either to continue in the bad state. Clear? Now, we are actually trying to evaluate the option of abandonment. In this case, we have to first of all calculate that what is the incremental benefit from the abandonment. So we are talking about solution 6 now, right? So step 1 is about benefit from abandonment, right? So had I abandoned everything, I will get 60 crores. But had I continued in the bad state, I would got 20 crores. So the incremental benefit on account of abandonment is 40 crores. So this is incremental benefit on account of abandonment is rupees 40 crores. Clear? Step 2 is basically the expected benefit, right? Now this has a probability. The probability of collapsing the price was how much? 30%, right? So 40 crores minus 30%. So that means there is a 12 crore benefit that we can get in case we have to trigger off the abandonment option. Step 3 is to calculate the present value, which is 12 crores divided by 1.10 raised to the power 2. 9.92 crores, right? So this is after 2 years. If I would have abandoned, I would have got 12 crores. The present value of this is 9.92 crores. So my strategic NPV, by strategic NPV means the overall NPV, means what? So I had 185 minus 200. This was my initial investment. So minus 15 was my initial NPV gap. In that, I will add 9.92 crore as my present value, right? This is what I was supposed to get. So this will become minus 5.08 crores. Okay. So the abandonment option value is how much? 9.92 crores. Correct. So what are we concluding? We are concluding that abandonment option limits the downside risk, right? And it behaves like a put option. Correct. It's ultimately helping you to kind of realize this value just like a put option, right? You're already into that project. In case you want to abandon, you will be able to limit your downside risk. Downside risk and acts as a put option. Because had I not done this abandonment, my NPV is negative. Yeah. Then let's move to question number 7. Yeah. A power generation company uses natural gas. The current project NPV is 50 crores, right? They are actually incurring 50 crores. They are actually getting an NPV of 50 crores is something that we have. Management can switch between natural gas or fuel oil, which is but obvious, right? Because they have to generate power, they need some fuel. Currently, they're using natural gas. They can also use oil. If gas prices increases significantly in future, switching can generate savings with a present value of 25 crore. So they are saying that in case tomorrow the company decides to move to oil, because oil being cheaper, it will help to generate a savings of 25 crores. Probability of gas price spike is 40%. So there is a 40% chance that this 25 crores will come to us. And there is a switching cost because you will have to change the plant, you have to change the equipment. So that switching cost is around 5 crore. The discount factor to be used is 0.85. We are not sure whether it is for 1 year, 2 year, but they've given us a discount factor directly. Determine strategic value of switching flexibly. So this is again a case of, let's say, tomorrow my cash flows are dependent on some X event. Then how would I evaluate the decisions? Yeah. So this is basically solution number 7 now. So first of all, let's calculate the economic gains if gas price hikes and switch happens. So this is 25 will be the incremental cash NPV that we will get, and 5 is the cost of such switching. So 20 is what the economic gain will be. Correct? Step 2, expected gain is actually 20 into what's the probability? 40% again, right? So 8 becomes my expected gain. Step 3 will be the present value of expected gain, which is actually 8 into 0.85, which is actually the discounting factor, right? So 6.80 becomes the present value of expected gains. Then step 4 is about the strategic NPV, right? Which is within the current NPV. If this switch happens, what would be my overall NPV looking like? So the strategic NPV will be the overall NPV is 50 is already there plus 6.8 is also there. So 56.80 will become the value for strategic NPV. So hence switching option value is equal to rupees 6.80 crores. The strategic value is equal to rupees 56.80 crores. Okay. So in case the switch happens, it will still be beneficial for the company, power generation company. Now we can move to the next question, students, which is the question number 8. Delta Infrastructure is considering a smart city project. The investment today is 120 crore into that city. Current present value of projected cash flows is 125 crores. Management can defer investment for 1 year. After 1 year, if it goes up or down again, it depends with the different values. It can be 170 or it can be 90. Investment cost after 1 year still remains to be 120 crores. Risk-free rate is 6%. Required using risk neutral valuation. Compute the value of option to weight. Now in this, the probability is not given. So what are we going to do? We are going to calculate the probability using the risk neutral method, right? We just now have revised in the risk neutral method. There is a way to calculate the probability, right? And in the detailed sessions also for financial options, we know how to calculate the probability. We know what is the upside and downside, right? U and D, which is 170 and 90. The starting point is 125 and the risk-free rate is 6% using which we can do the present valuation. So it is just about connecting the facts here. So we are talking about solution 8. Now, payoffs after 1 year. Upstate is how much? 170 minus 120. So net NPV of 50. Downstate is how much? 90 minus 120, which is minus 30, right? So again, similar thought, if the downstate will lead to minus 30, the company will not invest. In case of downstate, correct? And hence the payoff can at max be zero. It cannot be negative. Step 2 is basically determining probability, or I can say risk neutral probability. So the probability of upside is 170 divided by 125, correct? So this is the U that we calculate, U and D, right? So 170 is the higher price, 125 is the current price. So it comes as 1.36. Similarly, D we calculate as 90 divided by 125. So this becomes 0.72. So probability is actually 1.06 minus 0.72. So this 1.06 is basically the risk-free rate that we have got, minus 0.72 divided by 1.36 minus 0.72. This is the probability of price going up. So we solve this 0.34 divided by 0.64. So the probability of prices going up becomes 0.53125. And hence the expected option value is 50 multiplied by 50 is this 50, right? Which is the probability of higher value multiplied by 0.53125 plus 0 into 0.46875. So the probability of prices going down will be 1 minus 0.53125, which is equal to 0.46875. Correct? So this becomes 26.56. So the expected value of the option becomes 26.56. This is step number 3. Step number 4 is the present value. 26.56 divided by 1.06. 25.06 becomes the present value. So the value of waiting option is 25.06 crores. Clear, students? This was an interesting question because this was a good mix between the risk neutral method to calculate the probability and the real options, in which the idea is to wait and then to assess what is my overall option value going to be. I hope the discussion is clear. Okay. So with this, the topic of derivatives revision and the additional questions is complete, students. Let's break for 10 minutes. Then after that, we will be starting with the discussion on the interest rate risk management. We will have a quick revision and a question also on the interest rate risk management. Post that, we will also be covering some of the revisionary MCQs, and then we will be wrapping up the session. Yeah. So let's break for 10 minutes. Yeah. let's go to interest rate risk management topic. So let's do a quick revision of this. Then along with that, a question and some MCQs later on. Okay. So interest rate risk management students, we started our discussion stating that first of all, why there is a need to pay an interest. Is it on account of time value of money, inflation, and also on account of the risk of non-payment to the person from whom we have taken the loan? So these are the two main factors because of which the interest is charged. Why time value of money? Because obviously the 100 rupees is spent to purchase one basket today, it will be amounting to 110 after 1 year, right? So the same basket of goods will cost a higher amount than today to be purchased after 1 year. So this is a concept of time value of money or inflation. And similarly, risk of non-payment is a counterparty payment risk, wherein if I'm lending amount to someone, I am undertaking a risk of not collecting it on time, or let's say not collecting it at all. So hence that might pose us to the risk of non-collecting the amount. Higher the risk, higher the interest rate, because uh, it's a so basically it is compensating for the risk, right? And lower the risk, lower will be the interest rate. So this is what we have discussed. Now another thing that is very very important is interest rates are always dynamic. They always keeps on changing. They are not static or they are not fixed. The reason being because there are some open market operations that even RBI does, and also the banks are also free to decide basis market forces of at what rate they want to borrow, at what rate they want to lend, right? So hence it is also dependent on the market forces where the interest rate comes out to be. Since the interest rates are bound to change, correct? Interest rates are always bound to change. It leads to interest rate risk. So the interest rate risk means that the changes in the interest rate to what we have expected. If it is plus or minus, then it leads to the interest rate risk. So interest rate risk impacts financials of the company. Obviously, yes. Because if you talk about a P&L on the income side and on the expense side, the banks and financial institutions have majoritarily as interest income and interest expense. This is interest income and this is interest expense. Since this is there, this impacts their overall net interest income. Reason being, tomorrow, if the interest rate goes up, the interest income will also go up, but at the same time, the interest expense will also go up, right? It might go up in different magnitudes, it might go up in different cases. So that's there. However, if the interest rates are going down, the similar impact can be there on the interest income and expenses also. So it's a overall issue that comes up in terms of the income and the expenses at a net interest income level. Yeah. And hence the changes to the interest leads to the interest rate risk. The interest rate risk leads to the financials implications on the company, on the banks, on the financial institutions, and hence there is a need to hedge the interest rate risk. Hedge means taking protection against the interest rate risk management. Now, there are different methods to do so. One, we have a traditional method, and second, we have a modern method. So, the traditional method talks about the asset and liability method, ALM, and the second is the forward rate method. Modern method, on the other hand, refers to interest rate futures, interest rate guarantees, and interest rate swaps. Right? So traditional method is basically the asset and liability method, which is ALM, and forward rate is FRA. Forward rate agreement is FRA. Now let's discuss them individually. The first one is the asset and liability method, which is ALM. In this case, the timing of cash inflows and cash outflows should match. Or if they are having a mismatch, then through some interventions, we make sure that once we are receiving the collections on assets, then we are paying to the liability. So this is more about matching the maturity of cash inflows and cash outflows, right? The way it helps is it minimizes the need to borrow or invest for short-term purposes. And the moment you borrow or invest less for the short-term purposes, you will be able to mitigate the interest rate risk impact onto your financials. And this is a very powerful tool used by a lot of banks. There is a specific asset liability. Bank B needs to invest after 1 month for 3 months at the rate of rupees 1 lakh, which is also true. Correct? So the bank B needs to invest after 1 month for 3 months. This is rupees 1 lakh. Now it has to borrow, it has to invest. The current interest rate is 5% per annum. The forward interest rate looks like 6% per annum, which is after 1 month, the interest at which the borrowing and lending will happen is 6%. This is not for today. This is after 1 month. Now, what do they will do? So they will enter a FRA, which is a deal today, forward rate agreement. They will enter into today. So after 1 month, they will execute it. And in the execution, they will say that the duration is for 3 months. After fourth month, it will get ended. So FRA of 1/4 will get into the picture. So this is denoted by FRA 1/4 means what? After 1 month, it will start, and after 4 months, it will end. So 4 minus 1, 3 months becomes my duration, right? 3 months is the duration. So the way to denote is what is the starting month from now, ending month from now, starting month from now, and ending month from now. Similarly, FRA 3/6 also is after third month, it will start from now, and after 6 months, it will end from now. So starting point and duration can also be taken. So similarly, FRA 12/18 means that it will start after 12 months. The actual lending and borrowing will happen after 1 year. Okay. But the duration will be for 6 months, which is 18 minus 12. So this is how the FRA is denoted. Now, in our case, we said that Bank A and Bank B entered into an FRA of 1/4, okay, on the 0th period at the rate of 6% per annum. After 1 month, what happens? In case of case 1, actual interest rate is what? 8%. Let's assume to be different cases. The first case, it says that the actual interest rate comes out to be 8%. So here, what will happen? Bank A will say that I have agreed to borrow at the rate of 6% per annum. The actual interest rate is 8% per annum. So I will enjoy a gain of 2% because in the market 8% is the borrowing rate. I am able to borrow at 6%. So there will be a gain of 2%. It is similar to a forward or a future in a financial option. Similarly, for the 6%, The bank B will say that I have agreed to invest at 6%. The market rate is 8%. I am having a loss of 2% because I have to honor my commitment. I have to lend at 6%. Had I not lended this 6%, I would have lended in the open market at 2%. Clear? Then case number two, students, is when the actual rate actually drops. It drops to 5.5%. Then there is a loss of 0.5%. Correct? Because here the bank A will say that I have to borrow after 1 month at the rate of 6%. Actually, I can borrow at 5.5%. So in such a case, I am having a loss of 0.5%. Correct? Because had I gone in the open market and borrowed at 5.5%, my borrowing rate would have been 0.5% lower. Clear? Then also let's talk about gain. In case of Bank B has a commitment to invest at 6%. The actual market rate is 5.5%. So Bank B will say that I will actually go and uh, in the open market, I would have got 0.5% less. So I am having a gain of 0.5% here. Clear? Case 1, Bank A would get 2% and Bank B would pay 2%. Right? This is what it will happen in case they are settling on a net basis. In case they are settling on a gross basis, they will do the actual lending and borrowing at the rate of 6%. Right? But in this case, they are doing what? They are doing on a net basis. So Bank A would get 2% and Bank B would pay 2%. How this calculation will happen? On the notional amount of 1 lakh, 8% and 6%. Why I'm saying notional amount? Because this is not getting paid or received, right? We're talking about the net movement. So 8 minus 6 for 3 months. This becomes my payoff after 1 month, right? After 4 months, sorry. So how I have to arrive at is I have to arrive at the beginning of first month, or let's say beginning of the deal. That is after end of the first month. I will have to settle for this. So this becomes 490.19 by taking a present value of 8% for 3 months. Clear? So the present value at the start of the loan will be this much, 490.19. Case 2, Bank A will pay 0.5% and Bank B will receive 0.5%, right? So 1 lakh on 6% minus 5.5% divided by 1 plus 5.5% into 3 by 12. So this is also the case where 0.5% is the incremental value. However, students, please note that always denominator, we are using the actual interest rate, right? It was 8% above, it is 5.5% because the present value will be done basis the actual rate. Okay. So the present value to be taken basis the actual rate. Bank A would pay 123.31 to Bank B. Right? In this case, Bank B was the gainer and Bank A was incurring the loss. Correct? Now what's the formula for this payoff? N multiplied by notional amount multiplied by RR, which is the actual interest rate, minus FR, which is the forward rate, into time period is the duration for which the execution of this loan will happen. Clear? Bank A is the borrower and Bank B is the lending position. We call Bank B as the purchased FRA and hence the long position. Where the interest rate increases, the gain also will increase. The interest rate goes down, the gain will also go down. Similarly, Bank B is the lending bank, which is basically having a short position, or we can say that they have sold the FRA. If the interest rate increases, their gain will go down. Just now we saw that, right? If it is 8%, Bank A will gain, Bank B will lose because Bank B is into the lending position. The situation is reversed where the interest rate goes down. the gain will increase for bank B because they are into the lending position, students. Clear? So this is a gist, or this is a summary of how the forward rate agreements looks like. Now comes the crucial step, which is how do we value the FRA, right? How do we really value the FRA, which is the forward rate agreements? Now, the valuation, for understanding the valuation, we just need to understand a concept where that in the market, the interest rates are quoted basis the difference maturity. Now, please pay attention. The interest rate for a 12 months maturity on a per annum basis will be different to the interest rate for 6 months maturity on a per annum basis. Okay. So, for example, 6 months maturity can have, let's say, 5% per annum as the rate of interest. Similarly, 3 months maturity can have 4% per annum as the interest rates, right? FRA, if we talk about in this case as 3 by 6, it will actually depend on from this 3 to 6 how we move, right? We have 0 to 6, we have 0 to 3, both the numbers we have to calculate 3 to 6. How can we do that? We just assume it to be the x, right? So this is the thing that I was explaining, right? Different interest rates available for different maturities in the market. And hence, whenever a rate is quoted, it is always quoted with reference to the maturity of that loan, or let's say borrowing, right? So it has different interest rates. One more thing, higher the maturity, higher the interest rate will be. The answer to that is because higher maturity have higher risk possibility, and hence it will lead to the higher interest amounts. So 1 plus 5% for 6 months will be equal to 1 plus 4% for 3 months, another multiplied by x percentage for 3 months, right? So this x is something our FRA rate will be, at which we will after 3 months, right? So x becomes 5.94. This is also called as theoretical minimum value because in theory, x should be 5.94 so that the rate of 6 months, the rate of first 3 months, and the rate of this FRA becomes in tandem. Now, in this case, if FRA is available at lower than 5.94, for example, we are talking about this FRA only 3 by 6. If it is available less than 5.94, then what do we say? FRA is underpriced. And what happens if something is underpriced? We buy it. We take a long position. So if FRA is underpriced, we take a long position in FRA. So hence we borrow through FRA. Okay, we are going to borrow through FRA. So if we are going to borrow through FRA, like this leg, we are going for a borrowing. Even for 0 to 3 months also, we have to go for borrowing. Now we are devising the arbitrage strategy, the hedging strategy about it, right? So 0 to 3 months also, we have to go for the actual borrowing. And then for the 6 months, I have to actually invest for 6 months. Right? So 0 to 6 months, I will end up investing for 6 months. So what will happen? After 6 months, I will get the maturity proceeds of the investments. And what I've done here, I've borrowed and invested. So here I will have to redeem the borrowing and pay. Again, I will take a FR. Again, I have taken a FRA for borrowing. So here I have to pay the amount, and here I have to receive the amount. But there will be a difference because the actual FRA rate is less than 5.94%, and that will be my arbitrage profit. So borrow for 3 months, FRA 3 by 6, and invest for 6 months. So what will happen? You borrow for 3 months, 1 lakh rupees. After maturity, you end up paying 1 lakh 3,000. Let's say 3% is the interest. And through this FRA 3 by 6, the another borrowing, you end up maturing at 1 lakh 6,000. But you have invested 1 lakh for 6 months, you will end up receiving higher amount of 1 lakh 7,000. So there is an arbitrage gain of 1,000 rupees. This is what we were talking about, that there will be an arbitrage if the actual FRA is getting traded at a higher or a lower amount. In this case, it was a lower amount, it was underpriced, and hence we have to buy through FRA. Now, case 2, where FRA is overpriced and it is higher than 5.94%, students. In case of overpricing, what we do, we actually do the short selling of FRA, lending position or investing through FRA. This is what we resort to, right? So short sell FRA, lending position or investing through FRA. Now in this case, what happens? We actually end up doing an investment through FRA, then 0 to 3 months also is investment, but 0 to 6 months is actually borrowing. That happens. So borrow 6 months, investment for first 3 months, then again invest through FRA for next 3 months, which is selling the FRA. So here you have to pay on maturity borrowed amount. Here you will realize on maturity the investment amount. Clear? So what will happen? You will sell through FRA. So there is a gross and net. So gross is basically actual borrowing lending at the rates at which we have specified in the FRA. It is just like forwards, right? Forwards are settled on gross basis. Net is basically futures, because futures are always settled on net basis, right? Net payoffs. Clear, students? So till now, we have covered two methods. The traditional one. The first one is the asset liability method. The second one is the the forward rate agreements. The forward rate agreements are over the counter contracts which are specifically made to the specifications of the borrower and the lender. Clear? Interest rate futures are one of the modern methods for the interest rate risk management, and they are based on the premise that bond prices is inversely proportionate to interest rate changes, right? So the bond prices is inversely proportional to the interest rate changes. The interest rate is higher, the bond prices becomes lower. If the interest rate is lower, the bond prices becomes higher. So I hope you are able to follow this, right? This is a concept that we have already studied and know through the bond related topics, right? Now, what happens, students? Interest rate futures are not available as a standard product in the market, but the bond futures are, right? So, since there are bond futures available, so we make use of those bond futures to carry out the interest rate futures as an instrument for interest rate risk management. If the interest rate is higher, if we are facing a risk that interest rate might go up. So in this case, what we do, bond futures, we will short sell, correct? Because if interest rate goes up, the bond prices will go down. So this can be correlated to, so this is one, this is one. So 1:1, we are saying that if interest rate goes up, bond prices goes down, and we will gain when bond prices goes down by short selling it. The moment we short sell it, we gain. So the bonds futures we will have to short sell. If the interest rate goes down, the bonds futures has to be long position, because if interest rate goes down, the bond prices will go up, and we will be able to gain when the bond prices will go up by buying a bonds future. So this is a simple correlation, students, where the bond futures are used to do the interest rate futures related interest rate risk management. So till now, if we have seen, we have discussed about forwards, we have discussed about futures. So this is, I'm talking about the financial derivatives, right? These are the ones that we have just discussed between today first half and the previous session. And here we are talking about what? Interest rate derivatives, right? We have talked about FRA, forward rate agreement. We have talked about interest rate futures, which is through bond futures. Clear, students? So this FRA of forwards is actually similar to the forwards. The IRF is similar to the futures, right? This is what I'm trying to say. Now, the third category of options is basically what we are going to do now, which is the interest rate options. So here there is a fixed commitment to execute. Option has a option to execute, right? If it is favorable, then it will be executed. If it is not favorable, then it will not be executed. So this is how options are. So interest rate options slash guarantees. Okay. Now let's talk about this. So first of all, let's talk about a cap option, right? A cap option, like in financial options, it has two parts, right? Call option, put option. So here also first talk about cap option. So cap option, let's start with A. A is a contract, right, privilege, but which is not an obligation, right? Again, this is the similar thing that we have studied in the call option, right? It's not an obligation, it's a right, it's a contract. Of what? To borrow, right? Here, instead of to buy, in case of call option, here it is to borrow. That means taking a borrowing position of a specified amount, which is a notional amount, at a specified interest rate. So this is the strike rate, correct? That X% is going to be the specified interest rate on a specified date. So let's say the borrowing need to happen after 1 year. So this on a specified date will mean that after 1 year, at this interest rate, the strike rate, specified amount will be borrowed. Clear? So the buyer towards the holder or the borrower, it's same, right? Because they are having the hold, they are holding the cap option, they are the buyer of the cap option, and they are similar to a borrower. Clear? Floor options. Floor options are also contracts, rights, privilege, but not an obligation to invest a specified amount, which is a notional amount, at a specified interest rate on a specified date. Yeah. So this is basically to say that the interest rate is also specified, which is a strike interest rate. Specified date is also again the similar logic, and the notional amount, right? Here the holder or the buyer is actually acting as an investor, because here the right is to invest, not to borrow. So this is a seller of floor option, and hence this is a borrower. The premium is actually paid by the buyers, whether it is a cap or a floor, and it is received by the seller. So in case of a cap option, the borrower option becomes the investor, because that person is purchasing the right to invest. Similarly, the writer of the floor payoffs. Now, how it will happen again, students? Because this is a cap option, this is a floor option. So these are the options. If these are favorable, then there will be payoffs. If these are not favorable, then there will be no payoffs. Let's understand how. In case of a cap option, it is a right to borrow. In case of a floor option, it is right to invest. Right? We're talking about the holder or buyer. So 10% is the strike rate in both the cases. Let's assume for a moment that 10% is the strike rate. Premium is 1% each. Let's assume that as well for a matter of fact. The actual interest rate is basically 12% and 12% that has moved up. Now, in case of a cap option, if the interest rate is higher than the strike rate, then it becomes a gain to the option holder. So gain in the options becomes 2%. So 2% will be paid by the option writer to the option holder. Similarly, whether it will become a loss. So 12 minus 10, will it become a loss? The answer is no. It will not become a loss because this is an option. This is simply out of the money. There will be no payoffs that will be settled here. Clear? Now another one. Let's assume the actual interest rate is 8%. If the actual interest rate is 8%, in that case, here also there is no gain or loss. Correct? There is no gain or loss. However, here there will be 2% gain, which is 8% minus 10%. It's a right to invest. Right to invest at the rate of 10%. However, in open market, the investment can be done at 8%. So this option is favorable. It's in the money, right? And the extent to which it is in the money is 2% of the notional amount. So hence there will be a gain on this 2%. Clear? So this is how the payoffs of interest rate options slash guarantees are there. So you pay premium, and in turn you get a insurance kind of a guarantee that if the interest rate moves in an unfavorable direction, the option writer will make the loss good. And the similar concept, students, we have also discussed in the financial options as well, right? Wherein there is an option. It's not just a obligation, right? It's an option because you are paying a premium, and the premium becomes the sunk cost. Correct? Perfect. Then let's move ahead. So these are the questions that we have discussed in detail in the previous sessions. Okay. Now let's come to the third part of the modern methods for interest rate risk management. So let's start with interest rate swaps, right? Interest rate swaps are an interesting topic. How? So interest rate swap. So interest rate means the regular interest rates that are going. Swap means an exchange of certain things, right? Now, how it will work is, let's say there is a company A and there is a company B. Let's first focus on these two companies. Company A is basically a well-established company, and they have a preference to borrow in the floating rate of percentage. So, see, students, the way you can borrow in the market is always two ways. One, you can either borrow at fixed rate, or second, you can borrow at floating rate, right? So, company A wants to borrow at floating rate of interest because they have a good they have a good risk bearing capacity, right? So they approached their bank, and their bank quoted that in case you want to borrow from us, we can pay you a fixed price of 7%, and we can also pay you a floating of equivalent to MIBOR. MIBOR is Mumbai Interbank Offered Rate, right? So this is the rate at which the banks actually lend or borrow in in between themselves in the Mumbai market, right? This is what it means. Company B is a new company, right? Company B is a new company which is having an option which wants to prefer a fixed kind of a borrowing structure, because they are new company. They don't want to take a risk that tomorrow if the floating rate increases very high, they will end up having a big amount of risk on their financials. So what do? They actually get into a fixed rate of 10% and a floating rate of MIBOR plus 1%, right? Now, what do? So there are two options, right? They approach to the swap bank with both their options, both company A and company B. Now approaches to the swap bank. Company A says that I am getting a fixed of 7% and a floating of MIBOR, but my preference is to do at a MIBOR. Company B says that I'm getting a fixed of 10% and floating of MIBOR plus 1, but my preference is to stay with fixed. So what does this bank does is, it actually takes into account both the proposals and it creates different options. So the first option in this case is that A borrows in fixed and B borrows in floating. The moment it happens, 7% plus MIBOR plus 1%, so it gives us MIBOR plus 8% as an overall option. Option 2 is basically it asks A to borrow in floating and asks B to borrow in fixed. Then what is the overall rate? MIBOR plus 10%. So these are the individual borrowing preferred rate. But if you compare this option 2 with option 1 seems to be cheaper, which is MIBOR plus 8%. So this one does not remain an option. So the option 1 becomes better, which is MIBOR plus 8%. But this is not the individual preference way. So what does swap bank does? So swap bank tells to company A that you take a loan on fixed, okay, and it tells to company B that you take a loan on floating, because that's what the preferential arrangement is. But company A says to the swap bank that I have to actually get into the floating rate. So swap bank tells to company A that you pay me the floating rate and I will pay you 7.75 percentage. So ultimately, what will happen for you is whatever you are paying as 7% fixed, I am also giving you fixed, but you end up paying to me my bar equivalent amount. So that your preference of paying ultimately in the floating rate is established. Clear? Similarly, from bank B's perspective, if you see, and company B's perspective, if you see, company B will pay MIBOR plus 1% to bank B. So swap bank will actually collect MIBOR equivalent amount from company A and it will pay to company B the MIBOR equivalent amount. So company B will get variable amount and it will pay the variable amount of MIBOR, and in turn company B pays to the swap bank as 8.25%. So, in a nutshell, what is happening? Company A's original preference is retained, and Company B's original preference is also retained. How? So, let me go to this. Yeah, after swap, what will happen from Company A's perspective? MIBOR is payable to the swap bank. 7% is payable to bank A minus 7.75 is receivable from swap bank. So the overall cost of borrowing, you see students, it has come down from MIBOR, which was originally quoted by bank A, to MIBOR minus 0.75%. So this is converted into the floating obligations. Company B is actually MIBOR plus 1% paying to the bank B minus MIBOR it is receiving from the swap bank plus 8.25 paying to the swap bank. So they end up paying 9.25, which is fixed, and this is converted into the fixed obligations. So the total collection is MIBOR minus 0.75 plus 9.25, right? This is bank, this is company A, company B. So overall interest payout is how much? MIBOR plus 8.5%. Correct? And what was our total? As per option 1, MIBOR plus 8. So in a nutshell, to the organization, to the bank A and bank B, they are collectively supposed to pay them how much? MIBOR plus 8%. So 0.5% is the commission that is actually remaining with them. And this is something that is worked out by the swap bank. Clear? So zero point 0.5 swap bank will keep. Similarly, 0.25 benefit is given to them. Sorry, 0.75 benefit is given to them, and 0.75 benefit is also given to them. So comparison between pre and post swap situations. Had there been no swap, company A would have paid MIBOR, company B would have paid 10%. There is nothing in terms of the swap ban. There is a swap. Then what has happened? MIBOR minus 0.75 is the overall interest rate, 9.25 is also the interest rate, and 0.5% is the swap bank amount. So the savings comes out to be 0.75, 0.75, zero point 0.5, as overall 2% is the savings that has arrived. Right? Which is also the comparison between both the options of 2%. So students, in a nutshell, what is happening through this swaps? Through this swaps, what is happening? The interest rates at an individual level that they would have borrowed were higher, but basis this arrangement, they are able to retain it to a lower level, students. Yeah, clear? I think that's all from the revisionary of the concepts, we can move to the question now. Let me just see if there is something is left to be discussed. Yes, so let's also talk about the gap exposure because this is also one of the crucial things. So, students, there is a term called gap exposure. So, what do we mean by this? First of all, we need to understand that what is interest rate sensitive assets and interest rate sensitive liabilities. So, the interest rate sensitive assets are the ones whose value is actually dependent on the changes in the interest rates, right? So, the changes in the interest rate actually leads to the changes in the interest rate asset amount. So, this typically happens in those assets which are linked to a floating rate of interest. Similarly, interest rate sensitive liabilities are such liabilities which are actually linked to the movement of the interest rates, right? And hence they are called as the interest rate sensitive liabilities. If the interest rate increases, the interest rate sensitive assets will also undergo a change and interest rate sensitive liability will also undergo a change. Okay, so this is technically clear. Now, if interest rate sensitive assets are greater than interest rate sensitive liabilities, then we call it as a positive gap exposure. If interest rate sensitive assets is lower than the interest rate sensitive liabilities, we call it as a negative gap exposure. In such a case, if interest rate goes up, the net interest income will also go up. In such a case, if interest rate goes up, the net interest income will go down because your interest rate sensitive liabilities are higher. And the moment interest rate goes up, you will end up losing amounts on the interest rate sensitive liabilities. So, net interest income is something that will depend on this situation. Okay. So this is what the gap exposure is, right? So this is used to estimate that whether in the balance sheet your net interest income is going to be, influenced or how it is linked to the higher interest rate or a lower interest rate to arrive at such positions. Okay. Now let's move to the question on interest rate risk management. Yes. So Prism Motors has outstanding floating rate on MIBOR debt. So can I say that this is a interest rate sensitive liability? Yes, the answer is yes, because this is a sensitive to MIBOR interest rates, right? And 500 crore is the debt. To reduce uncertainty, the company enters into a swap. What is the swap? Pay fixed 8.2% and receive floating. Yeah. So currently, Prism Motors is paying MIBOR, right? What they are going to enter into a swap. Under swap, they will receive variable and they will pay 8.20 fixed as percentage. So they have already entered into a swap. After 1 year, The current market swap rate fixed has moved to 10%. The remaining maturity is 3 years, for which the present value interest factor accumulated at the rate of 10% is 2.487. This is the accumulated factor, students. Please do remember. Required, calculate the swap value. So, swap value, students, is basically determined to see whether you are having a loss or a gain, or what is the value from the forward looking lens that you can assign to your swap today. Clear? Because today you have agreed to pay 8.2% for receiving a variable, but tomorrow the interest rate has increased to 10%. So whether your current swap is valued at what compared to what it is operating in the market. So that's what the question is asking us to calculate, right? So let's first see. Yeah. So the contract, let's first try to put the solution. So the contract is fixed at 8.20 percentage. Market swap fixed rate is 10 percentage. Clear? Now, what is the advantage that we are getting is 1.8 percentage. And why I call it as an advantage? Because I am paying a lower amount. So Prism Motors is paying a lower amount. Prism Motors is paying a lower amount compared to market fixed rate. Correct? So this 1.8 percentage turns out to be advantageous. Then what's the swap notional amount? Sorry. This is actually 500 crores. So if you see on 500 crore, which is the notional amount, I was paying my bor, I was receiving my bor, right? So that actually nullifies. Pay my bor originally under swap. Receive my bor and pay 8.20 percentage. Correct? So overall my overall savings compared to market will be 1.80 percentage multiplied by 500 crores. Yeah. So this is actually given as 9 crores. So this is the annual savings for next 3 years standing as on today, right? Because if you see, we are here and for next 3 years, we know that 10% and 8.2% is going to be the gap between our contract and the market. That means mark to market, if I do, I will get this benefit for next 3 years, right? So 9, 9, and 9. This is what I will get. So if I have to accumulate these 3 years of 9 and arrive at a present value here, then what I need to do? I need to take the present value interest factor basis the accumulated annuity, right? PVIFA at the rate of 10%, which is the rate they have given. So the annual savings for next 3 years will be 9 crores basis the swap fixed rate and market rate. Okay. So the next step is to finally calculate the present value of swap 9 crores for 3 years multiplied by or else 9 crore as is multiplied by present value factor for 3 years at the rate of 10%. So this becomes 9 crores multiplied by 2.487. So hence the present value of swap is equal to 22.38 crores. So this is what the present value of swap will be, and this is the gain. So what happens typically, students, here that this gain will be recognized in the books, right? This will also be accounted for, and this is also called as the valuation of swap, right? We did what? We actually did the valuation of swap. Although it looked easy because of the certain factors and the data given in the question, in reality there are a lot of other things also that comes into the play. But yes, this is the valuation of swap. Clear? So this was a bit different question because otherwise the questions are more on that the swap is constructed and formed and given to you. We have to evaluate what are the payoffs between, let's say, the one person and the other person, how the payoffs will be different Similarly, in case of interest forward rate agreements, the questions can be around how do you compute the value of that FRA, right? What is the pricing of that FRA that you can compute? Similarly, is there any arbitrage opportunity possible in that FRA through whether it is overpriced or underpriced, and how we can devise that arbitrage strategy? And interest rate futures are also very good topic where the bond related, inverse uh, proportion is used to basically curb the risk of the interest rate futures. Yeah. So now, students, let's come to some of the MCQs. Yeah. So what I will do is we will actually go through these MCQs. I will read out them. Then I will pause for some time so that all of you can think about the correct answer, the correct option in this, and then I will reveal the answer in some time. Okay. So let's start with all the three topics that we have covered between today's session and day before yesterday's session, right? This is primarily from securitization, derivatives, and interest rate risk management. The concept of tranching primarily aims to reduce the size of SPV, allocate the risk across different classes of investors, increase the number of underlying receivables, avoid compliance with the regulatory norms. So, this tranching was the concept where we studied that there are different classes, right? There are different classes basis the different risk basis the different returns, right? So this is what we have discussed. So just think through, student, what should be the right answer. Maybe you can write it somewhere. Then I will reveal the answer. So is it definite? Is it there to reduce the size of the SPV? Tranches, does it reduces the size of SPV? Not sure. Is it also to allocate the risk across different classes of investors? Increase the number of underlying receivables. This is basically we're talking about the originator giving more assets, right? And avoid compliance with the regulatory norms. So the correct answer here is, students, option B, because it is a way of allocating the risks to the different classes of the investors, right? The senior, mezzanine, junior, equity. In the case of company we discussed, right? Equity, preference, debenture holder. So those are the concept of tranching. In a securitization deal, the role of a servicer primarily includes. Now here we're talking about the servicer's role, providing credit guarantees to the investors, purchasing residual interest from SPV. I'm just removing the text here. Yeah. Purchasing the residual interest from SPV, collecting and managing cash flows from receivables, and lastly, rating the tranches issued by SPV. So, is it more to do about providing the credit guarantees, right? Which credit guarantees are also one of the parties in this securitization process. The second is a residual interest. Third is collecting and managing the cash flows from the receivables, which we also discussed, right? They are mainly responsible to make sure the administrative task of collecting and basically accounting it, managing it is kind of done. And lastly, the rating the tranches issued by SPV. So the correct answer here is, students, answer option C. Sorry. This is question number 3. Question number 2, the answer is collecting and managing the cash flows from receivables. Question number 3, which of the following best explains the primary purpose? Which of the following best explains the primary purpose of creating an SPV in a securitization transaction? To increase taxation benefits of the originator, achieve bankruptcy remoteness from the originator, to guarantee investor returns to enable higher leverage of the originator. So what all things they are responsible for? Either to increase the taxation in the benefits of originator, to achieve bankruptcy remoteness from the originator, to guarantee investor returns, to enable higher leverage for the originator. So relatively, the best placed objective or the purpose of SPVs is option B here, which is to achieve the bankruptcy remoteness from originator, right? In a pass-through securitization structure, cash flows from the underlying assets are, we are talking about pass-through certificates, right? Reinvested by SPV before distribution. Is there a reinvestment possible? First of all, we have to think through that. Second, paid to the investors after deducting only the trustee fees. Third one is distributed to investors immediately as received. And last one, allocated based on the credit rating of investors. So which option do you think, students? Just note it down in your respective places. So the which option is nearest to the pass-through certificate? The option C, which is distributed to the investors immediately as received. Okay. Now let's come to the derivatives related MCQs. A long forward contract on an asset with no income has a current forward price higher than its theoretical fair value. This creates, so we are saying that long forward contract on an asset with no income. So there is no income that is generated on that asset, has a current forward price higher than its theoretical value. Then what do you think should be? Arbitrage opportunity for the short forward, arbitrage opportunity for long forward, no arbitrage, a need to revise the spot price. So what we are saying is the forward is overpriced, correct? Forward is overpriced. So this question is saying now what we have to do in case anything is overpriced, students. So the point that we have to do is we have to short the forward, right? So arbitrage opportunity for short forward is the right answer. Second, which of the following factors does not directly affect the Black-Scholes value of a European call option? Volatility, dividend expected, risk-free rate, correlation between the spot price and the market index. So students, we have to tell basis the formula that we have gone through, which of the following factors is not a factor that is used in the Black-Scholes model. Volatility is used, dividend is also used because it impacts the spot price. Risk-free rate of return is also used. So the point that is not used is option D. Third question, the value of a futures contract on a dividend paying stock is typically spot price minus present value of expected dividend. Spot price plus present value of dividend. Spot price discounted at a risk-free rate. Spot price minus carrying cost. So this is relatively easy, right? We are saying that on a stock where typically dividends are paid, what is the right methodology to calculate the futures contract value? Obviously, in our examples, we have discussed that whenever there is a dividend, we have to reduce it. Whenever there is a transaction cost, we have to add it. The reason of reducing it because on forwards or futures, there is no dividend that is paid or received, right? So A is the right answer. Now, delta of a call option reflects. So this is the Greek, right? So the delta of a call option reflects sensitivity of option price to volatility, probability of option expiring worthless, expected change in option value per unit change in the spot price, and hedging ratio of gamma. So what is the correct answer, students? So the correct answer is option C, which is expected change in the option value with respect to change in the spot price, right? This is what the delta is. A portfolio is a delta neutral but gamma negative. A sudden large movement in the underlying asset price will likely cause the portfolio to. So this is basically a delta neutral but gamma negative. So this is again, gamma is also one of the Greek, right? So the four options are gain irrespective of the direction of movement, loss irrespective of the direction of movement, gain only if the asset price increases, gain only if the asset price falls. So I'll tell you the correct answer here is B, which is loss irrespective of the direction of movement because gamma is negative. Okay. Let's move to the next topic of interest rate risk management. A company expecting interest rates to fall would most benefit from which derivative strategy? If we are saying that the interest rate will fall, which strategy we will adopt? Do we buy a interest rate cap, sell a floor, enter into a receiving floating pay fixed IRS, and enter into a receive fixed pay floating IRS? So obviously, if I pay floating, I will be able to benefit from the fall. So the correct answer here is option number D. Okay. Then a bank has more rate sensitive assets than liabilities, is exposed primarily to which risk when interest rate rises? So if the interest rate rises and the interest rate assets is more, then we have just now discussed, students, right? Then net interest income decreases or it increases, duration gap or market value of the equity. Come on, tell me. So this will be net interest rate income increases because the assets are more than liabilities, and on assets you earn income. A borrower enters into a pay fixed receiving floating IRS. Which one of the following is true? Borrower is hedging against the falling rates. Borrower is hedging against the rising rates. Borrower will gain when the rates fall. Swap notional affect the cash value. So here we are receiving the floating. In case we are receiving the floating, that means there is an anticipation that the rates will be higher. So borrower is hedging against the rising rates. The payoff for an FRA seller becomes positive when we're talking about bank B. In our example, we discussed, right? Bank A and bank B. So this is bank B's perspective. Once the actual rate is greater than FRA rate, actual rate is lower than FRA rate. Both actual and FRA rate move parallel or volatility increases. So we discussed, right? When in the 6% is the FRA rate, 5.5% is the actual rate, then that is when the FRA seller will gain. So in this case, option B is the right option. Clear, students? So this brings us towards the end of the today's session. I hope all of you understood the revisionary aspects, MCQs, and some of the extra questions that we discussed. I request C. Ashish sir to help with the concluding remarks. Thank you, sir. Thank you.
Thank you, Devas sir, for completing this topic. Because see, I think you have almost covered three topics in a stretch, like securitization, derivatives, and interest rate risk management. So you have taken up one good questions because these questions are different from our earlier assignment questions. So
Yes,
with
sir.
this student, I think there are complete revision of three chapters, and I think these are one of the very important chapters have also come through. So student, now when we are coming to the end of this session, I am just sharing with you since there is right now there is no Zoom link facilities available with the student. So of course there is not we can say connect live connection between the students and the faculty concerned. So I request if you have any doubts, so please you send your queries at this email ID, or you can even contact us as this telephone number so that I can we can get it resolved. Even if you have any query relating to this your LVC issue, so we are also sharing one of more number. This is a concerned person 0120. It is a IT team there 3876 859. So Mr. Ajit Kumar is heading this team. So you can even contact to him and discuss the issue with him. It will be get resolved. And student, since in the last MCQs were also there, so the purpose of MCQs, see, independent MCQs are not generally asked in the examination. However, they strengthen the your concept knowledge or conceptual knowledge. And Divas sir, we thank you very much for sparing your precious time, and especially for the MCQs that you have framed and the questions, new questions that you have framed at your own. So which will be prove very helpful, fruitful for the student for in the forthcoming examination. So student,
Thank
please
you.
keep on learning, and thank you for patient listening, and have a nice day. Thank you, Divas sir, once again. Thank you. Have a
Thank
nice
you, sir. Thank you, sir. Have a nice day, sir.
Have a
Thank
nice
you.